Good day, everyone. So we are the Group 7 and having a task to discuss the regulation and supervision of financial institutions. So, financial institutions play a crucial role in the economic development of a country. Effective regulation and supervisions are essential to ensure their stability, promote trust, and safeguard the interests of customers and investors. So, this report explores the regulation and supervision of financial institutions with a specific focus on Banco Central non-bank financial services, the benefits of bank supervision, the purpose of supervision and regulation, and the role and objective of the International Monetary Fund and central banking.
So, ang Bangko Sentral ng Pilipinas is a central monetary authority of the Philippines. It oversees the country's financial stability, regulates financial institutions, and implements policies for effective financial management. So, what are non-bank financial services? So, non-bank financial services are financial services provided by institutions other than traditional banks. These services may include investment services, insurance, and asset management. They play a key role in promoting economic growth and providing access to capital for business and customers. So, BSP's roles in non-bank financial services is BSP supervises and regulates non-bank financial institutions to ensure a sound financial system. So the BSP focuses on maintaining financial stability, protecting customers, and preventing financial crimes like money and laundering. Types of non-bank financial services regulated by BSP. First is non-bank financial institution. Includes trust entities, insurance companies, pension funds, and investment firms. Second is electronic money institutions. So, institutions licensed to provide electronic money services. Third is investment companies and mutual funds. BSP monitors firms offering investment products to ensure proper conduct. Fourth is remittance and transfer services. Includes services that send money across borders. Regulatory framework for non-bank financial services. So, the BSP ensures compliance with the following regulations. First is the Non-Banking Financial Institutions Act. So governs non-bank financial institutions. Second is electronic money issuer regulations. Focuses on safeguarding electronic transactions. And third is Anti-Money Laundering Act. Prevents the misuse of non-bank financial services for illicit activities. Functions of non-bank financial services. First is capital mobilization, collecting funds from the public through investment products. Second is risk management, offering insurance and other products to hedge against financial risk. Third is credit intermediation, providing credit facilities and service to individuals and businesses. Key non-banking financial institutions. First is insurance companies. Provide life and non-life insurance services. Second is pension funds. Manage employee retirement savings. Third is investment firms. Investment products like mutual funds and unit investment trust funds. Last is leasing and financing companies for financing and leasing services to business and individuals. Advantages of non-bank financial services. First is increased financial inclusion by offering alternative financial solutions. Second, expanded access to investment opportunities for individuals and businesses. And last is a diversification of financial services beyond traditional banking. Challenges and issues regulatory challenges. The first is ensuring effective regulation of a rapidly evolving sector. Second is consumer protection, safeguarding against fraud and predatory lending practices. Last is technological risk, managing cybersecurity risk and electronic and digital financial services. BSP's measures to strengthen non-bank financial services. First is to improve regulatory oversight to ensure a stable and secure environment. Encouragement of financial technology or fintech innovations to improve access to services. And last is a collaboration with international bodies to align with the global financial standards.
Benefits of bank supervision. Bank supervision is a critical function of central banks, providing numerous benefits to both individual depositors and the overall financial system. So these are the benefits includes. First is protection of depositors. Bank supervision ensures that banks operate safely by maintaining adequate capital reserves and implementing sound risk management practices. This reduces the likelihood of bank failures, safeguarding depositors' funds. Let's consider a bank that has a high ratio of loans to deposits without sufficient capital reserves. If a significant number of borrowers default on their loans, the bank may face insolvency. Through regulatory oversight, supervisors can require the bank to maintain a minimum capital reserve, ensuring that it has enough funds to cover potential losses. This oversight reassures depositors that their money is safe, as the bank is less likely to fail. Second is financial stability. Bank supervision helps identify and mitigate systemic risk that could threaten the financial system stability by monitoring the interconnectedness of financial institutions. Supervisors can spot vulnerabilities early. So during the 2008 financial crisis, many banks were heavily invested in subprime mortgages. Effective bank supervision could have led to earlier warnings about these risky practices by enforcing regulations that required banks to conduct stress tests and report on their exposure to high-risk assets. Supervisors could have mitigate the build-up of systemic risk, thus preventing or reducing the severity of the crisis. Third is the fair competition. Bank supervision ensures that all banks adhere to the same regulatory framework, fostering a level playing field. This prevents monopolistic behavior and encourages competition, which can lead to the better services and product for consumers. Let's imagine a scenario where a large bank engages in predatory lending practices that smaller banks cannot afford to replicate due to regulatory constraints. With effective supervisions, regulatory bodies can enforce fair lending practices across all banks, ensuring that consumers are treated equally regardless of the institution they choose. This encourages competition as smaller banks can compete based on service quality and innovation rather than resorting to unethical practices. Fourth is the consumer protection. Bank supervision plays a vital role in protecting consumers that unfair practices, ensuring transparency and fostering trust in banking system. Regulators require banks to provide clear and accurate information about their product and services. Suppose a bank offers a credit card with hidden fees and complicated terms that are not clearly disclosed. Bank supervisors can mandate that banks provide transparent information about fees, interest rates, and terms. By enforcing consumer protection regulations, supervisors can help ensure that consumers are fully informed before making financial decisions, thus preventing exploitation and fostering trust in banking system. So in conclusion, bank supervisions provide essential benefits that protect depositors, maintain financial stability, promote fair competition, and safeguard consumer interest. By implementing effective regulatory frameworks and oversights, central banks can create a secure and trustworthy banking environment that benefits individuals and the economy as a whole.
The primary objectives of financial supervision and regulations are the following. First is maintaining financial stability. Financial stability ensures that the financial system operates smoothly and can withstand shocks without collapsing. So supervisions help identify and mitigate risks that could lead to widespread financial disruptions. Second is ensuring compliance. Financial institutions must adhere to existing laws, regulations, and ethical standards. So regulations enforce compliance to ensure that financial institutions operate fairly, transparently, and within legal framework. Third is promoting efficiency. Efficiency regulations encourages financial institutions to adopt modern technologies and innovate practices to improve service delivery. So it also promotes competitiveness, ensuring that markets are not monopolized and customers benefit from better products and lower costs. Fourth and last is preventing financial crimes. So supervision and regulations combat financial crimes such as fraud, money laundering, and terrorism financing. So regulations implements measures to ensure transparency and accountability, protecting the integrity of financial system.
The role of International Monetary Fund in a central banking. The International Monetary Fund play a crucial role in promoting global financial stability and economic cooperation. While not directly involved day-to-day operation of central banks, the International Monetary Fund significantly influence the policies and the practices. So there are 4 keys of rules of the International Monetary Fund. Number 1 is policy advice. So financial assistance under this is a loan. When you say loans, the International Monetary Funds provide financial assistance to member countries by facing balance of payments difficulties. The loans are often accompanied by unconditional measures including reforms to monetary and fiscal policy. The next is capacity building. Capacity building. So under this we have the training and the capacity development. So training. The International Monetary Fund offers programs to central banks of officials to enhance their skills and knowledge. And the capacity development is the International Monetary Fund support the development of a strong and independent central banking by providing technical assistance and sharing best practice. And the last one is the international cooperation. By fulfilling these rules, the International Monetary Fund helps to ensure the stability of global financial system. It promotes the economic growth and reduces the financial crisis. So under the international cooperations we have the Forum of Dialogue and Global Standards. So when you say forum for dialogue is the International Monetary Fund serves as a platform for international cooperation and coordination among central banks. And the global standards these are the key rules of the International Monetary Funds in central banking. So number 1 is policy advice. So under the policy advice we have the surveillance, country-specific advice, and technical assistance. So when you say surveillance, the International Monetary Fund regularly monitors the global economic and provides the analysis of economic and financial development. The next one is country-specific area advice. The International Monetary Fund tailored policy advice to member countries and financial sectors reform. And the last is technical assistance. The International Monetary Fund provides technical assistance to the central banks that strengthen their capacity in their areas, assistance monetary policy frameworks, the financial stability, and the risk management. And the next is financial assistance. When you say financial assistance, we have the loans. The International Monetary Fund is we're giving global standard. The International Monetary Fund promotes the adaptation international standard and codes of conduct for central banks, such as Code of Good Practice in monetary transparency in monetary policy. By fulfilling the
International Monetary Fund plays a significant role in supporting central banking systems globally, with its objectives primarily focusing on promoting economic stability, sustainable growth, and as well as in financial system resilience. So, there are 7 objectives of International Monetary Fund. First, maintaining monetary and financial stability. The International Monetary Fund provides technical assistance and policy advice to central banks to help them design and implement monetary policies that maintain price stability and control inflation. So, International Monetary Fund provides the of technical assistance and as well as in policy to central banks to help them implement monetary policies and to maintain price stability as well as control inflation. So the second one is capacity development. Capacity development, the International Monetary Fund helps strengthen central banks in institutional frameworks, governance, and operational capabilities. So this includes enhancing the ability to control monetary policy, manage reserves, and also regulates financial systems. And the third one is exchange rate stability. So by advising on exchange rate regimes and policies, the International Monetary Fund aims to stabilize exchange rates and avoid competitive devaluation that can disrupt global and investment. The fourth one is promoting sound and banking systems. So the International Monetary Fund assess central banks to improving their financial supervisory frameworks, including stress testing, macro-prudential regulations to ensure banking system stability. So, the International Monetary Fund promotes siya og sound banking systems para i-assess ang central banks to improve their financial supervisory. So, the fifth one is crisis prevention and management. So, through surveillance, the International Monetary Fund monitors economic risk and provides early warnings about vulnerabilities in central banking systems. In times of crisis, it offers financial assistance and guidance on reform measures. The sixth one is encouraging economic growth and development. So, the International Monetary Fund helps central banks align with their monetary policies with broader development goals. So, such as fostering economic growth, employment, and the poverty reduction. So, i-encourage sa International Monetary Fund ang central banks para nga ma-align ang ilang policies with broader development goals. So, the last one is fostering international cooperation. So, the International Monetary Fund facilitates collaborations among central banks to address global economic challenges such as climate risk and digital currencies and cross-border financial flows. So, sa International Monetary Fund, ga-foster siya into international cooperations sa mga facilities collaboration sa central banks para nga ma-address ang ilang economic challenges. So, that's all the 7 objectives of International Monetary Fund.